Brian Belsky, your take on things. What moves us higher? What keeps us where we are? What moves us lower in your mind? What do you see as potentially the next catalyst?
Well, Frank, thanks so much for having us. One of the greatest things about talking, the fourth person to talk, is that I can just piggyback on what everybody else says. No, listen, we've been, with much humility, we've remained bullish. And with much prudence, we've remained bullish because we believe in our process and our discipline. And so here's what our process and discipline is saying. We published a piece last week, and we talked about the market is transitioning from scare me to show me. I think we need to see going forward is a number of different things, signposts, in terms of green light, go longer term. I think there's a difference between very short term, which we typically talked about in this show, versus intermediate versus longer term. Longer term, we're steadfastly bullish. Our 25-year secular bull market theme remains intact. Intermediate term, we are bullish as well. On a short-term basis, I think we need to see some things. Number one, we need to see guidance and earnings growth. Guidance come back in and earnings growth remain consistent. Number two, we absolutely positively have to stop reacting to every single news event, every single thing out of Washington, or every single thing about tariffs. And then lastly, let's proceed on with respect to what's happening with the budget. I think that's what's going to end up happening. So I think Steph is absolutely spot on with respect to yesterday. It was a hallmark day. I think Josh is amazing with respect to what he said to trauma. What are the four ways you react to trauma? You fight, you flee, you freeze, and you fawn. I think with the trauma right now, you kind of freeze a little bit, and let's not fight this because we've been fleeing. So let's just relax. On the budget side, and what Jim's saying from a macro perspective, macro stuff is always delayed. But at the end of the day, earnings are coming in well, and we think the market is significantly higher by year end. It's just a matter of where you want to buy the market from here. All
right, we're talking a lot about where the markets are moving from those April lows. A big part of that move from the April lows, that's been tech. One of the names from those April lows that's really pushed the market higher, that's been Tesla. Josh, I want to get your take on Tesla. Of course, our David Faber has a very big interview coming up at 2 p.m. Eastern time right here on CNBC. He's going to sit down with Elon Musk and talk about Tesla. But that stock off of its April lows, bouncing about 50% to the upside. I just want to get your take on Tesla and the rest of the tech trade.
It's a huge bounce off the lows. This is a stock that's become synonymous with huge bounces off the lows. I think it's notable. It's still one of the worst of the worst three of the Mag 7. It's still down 14% this year. Apple's worst. It's down 17. Alphabet's down about 12. Those are the three underperformers of that Mag 7 cohort. I think what's most interesting about Tesla, from my perspective, because I'm not involved in the stock, is the degree to which the whole narrative flipped upside down. 6 months ago, it was Tesla's next big growth engine, before the robots are ready, is going to be these autonomous taxis and the cyber taxi, and they're going to kill Uber. Uber is the third best performing stock in the entire S&P 500 this year. Also my highest conviction position. It's up 52% while Tesla is down. And the narrative now is, who cares about who has the cars? This is going to be a software business and a network effects business. And Tesla's just one of several players that's going to have an app and a bunch of cars. There's only one player that's going to try to connect them all and own the consumer. So, these narratives about like the next engine of growth, and we're going to do robots, and we're going to do connected taxis, et cetera. Look, you're going to see a lot of volatility in the stocks that play in that arena. I guess my point is narratives change, and everybody agrees on something in January, and by April, they might all agree on the opposite thing. We've seen that with Alphabet just in the last 6 months. We're seeing it now with Uber versus Tesla, and you'll see it again.
All right, Belsky, you also own Tesla. Your take on this big run-up on this company seems to have been moving higher on a lot of just positive sentiment around the relationship with the White House, and also the idea, again, of autonomous driving, as Josh just pointed out. But it is still a car company with sales that seem pretty weak in the U.S., Europe, and also in China.
I think that's right, Frank. And at the end of the day, this stock was oversold. It was a momentum play, but you have to kind of go back and also look at the sector representation. The stock is in the consumer discretionary sector. And that's part and parcel while consumer discretionary has been hit so hard, and over why consumer discretionary has rallied back. So at the end of the day, you have to, I think, be really careful with respect to where you buy this stock in terms of momentum. We obviously own the stock. We actually bought more early this year, and we're a long-term player in this. We think actually Tesla is more of you want to buy Tesla and own Tesla longer term because of the operating system. Much like you own Apple 20 years ago, you want to own Tesla now for the same reasons with respect to the operating system for the next 20 years.
All right, so you bought earlier this year, so you kind of rode the wave between some of the declines and obviously big bounce off the April lows.
We did. And, again, we are underweight the stock. And our overall theme for the Mag 7 is you underweight the Mag 7 and you overweight other areas with respect to the sectors that represent the Mag 7, namely tech, communication services, and consumer discretionary. Again, that begs to define the stock picking environment that I think we're into, and we have entered officially the golden age of stock picking.
All right. Tesla shares up over 1.5% right now. Again, our David Faber is going to sit down with Elon Musk today, coming up at about 2 p.m. Eastern time. One-on-one interview with Elon Musk. I'm sure it's going to be a wide range of top topics. Again, an exclusive CNBC interview with Elon Musk. Our David Faber sitting down with the Tesla CEO. Moving on to other parts of tech, I just want to bounce this off you guys. According to B of A, profit taking in tech going on. The tech buying streak ending after a 7-week run. A wide variety of tech ownership here. Steph, I'm going to start with you. You own Meta. Those shares up about 25% off their April low. Yeah. What do you make of that run? Are you someone who wants to profit take when it comes to Meta at this point? Or do you feel confidence about this stock continuing the run?
No, I mean, the stock is still down 13% from its highs, right? And it's trading at 17 times forward estimates. And they beat. Total revenues rose 16%. Operating margins came in over 350 basis points better than people expected. I like the moat, the free cash flow, the management team. So to me, if this were to pull back, I would absolutely continue to add to it. And Amazon, same thing. It's down 16% from its highs, and it trades at 14 times EBITDA. Historically, it's traded about 17, 18 times. And they have an amazing moat, right? And not only in retail, but obviously AWS and advertising, which I think is the real surprise growth driver for the company going forward.
Everybody here owns Amazon. I do want to ask you about Amazon. Are you concerned about the tariff risk? About half of the revenues come from those third-party sellers. So much of that is sourced from China, not to mention other parts of the business could be impacted. If the consumer sentiment gets weak, that could potentially hurt the ad business. And then, the hyperscaler business could be impacted by higher data center costs, higher build-out costs through tariffs. So a lot of tariff exposure across the board.
Well, AWS grew 17% last quarter, and they're supply constrained. So, and they're 2 times the size of Google's cloud business, 1.5 the size of Microsoft's cloud business. So they are dominant. Retail, sure, there's definitely some risk there, but I think for them, they've done such a good job on operating profit improvement and distribution and facilities management. So I think they'll be able to handle it. There are the winners and the losers in retail. Amazon, Costco, Walmart are the winners. I hope eventually it's going to be Target as well. We'll see tomorrow, and I don't think it's going to be tomorrow, but I do think they'll get back. But I think you really want to be very careful in discretionary as well. But they're a winner, and they're a share taker.
Yeah, by the way, on Target, new note just came in, I believe about 50% of their items are sourced out of the country. So a lot of tariff risk in that stock, and not the same size grocery business as a Walmart.
They got more in Mexico, though, than in China. They have been moving their supply chains out of China. They're still about 20%, though, so there's absolute exposure there. They just have to execute consistently. The stock is trading at 11 times earnings and has a 4.5% dividend yield. I mean, they just have to execute, and I hope that they will. I think that they will, but the big number you're going to watch on Target is going to be the operating margin number. Do they get it to 5%? I think they will.
All right, as you mentioned, we're going to find out when earnings hit. Jim, coming over to you when we're talking about Amazon, your view on that company, again, also a big bounce off the April lows, looking at Amazon up more than 20%.
Well, Amazon Web Services is really the growth driver going forward. That's what I'm looking at, and I don't see any reason for that to disappoint going forward, both with GDP growing, what that implies as far as business spending, AI, et cetera, et cetera. It seems somewhat obvious to me, so I'm with Steph on this. If I can, Frank, please indulge me. I'd actually prefer to talk about Alphabet. I think that's more of a battleground stock, if you will, and for good reason. We had a very big argument about it 2 weeks ago. Not an argument, a discussion, a bull-bear discussion 2 weeks ago when the Eddie Q comments came out from Apple, and the question of what is Google going to become. Josh, you were there. We had a good discussion on this. Is it value tech? Is it growth? Where does it lie? And I think as we look at this now at roughly 17 times forward earnings, we know there are competitive threats out there. I would say this is just just solidly growth, not just at a reasonable price, but growth at a superb price. When you consider 17 times earnings, a company that actually is a verb. You Google something, I get it, there's still competitive threats there. Its own web services, its own moonshots, reducing share count. I can go on, but simply to say growth at a superb price is the main point here, 17 times forward earnings. To me, it seems obvious.
By the way, Alphabet's hosting its I/O event today. Belsky, you own this one as well. Your take on Alphabet. By the way, BMO out with a note, your firm, saying that Google search fears are overblown. A lot of concerns about Google search being disrupted by AI search and AI competitors. Your take on the stock?
You know, Brian Pitts is a great analyst for us at BMO, and he talked about a lot of the unicorn companies coming out of San Francisco using the Google platform in their AI once they kind of build up their infrastructure. That's number one. Number two, we recently added Google to our value portfolio for a lot of the same reasons that Jim talked about. We think from a contrarian basis, I think it's from common sense perspective, we're not going to stop using the Google machine to figure out where we're going. And then lastly, we've been long bulls on YouTube TV. YouTube is basically, the YouTube business is just as big as Netflix. And as you know, hopefully, we've been 13-year owners of Netflix, so we love that name. So I think Google is a name that I think that you can, will, and should be continue to building positions in, and it's one of the names that we really love longer term. Right.